When stock market volatility is high, investment anxiety can soar too. Fortunately, investors with a long-term strategy don't have to feel compelled to shoot from the hip, so to speak. Instead, they can afford to patiently sit back and remain focused on their long-term financial goals. Along these lines, we're here today with Phil McInnis, Chief Investment Strategist at Avantis Investors. Before moving into his present role in 2019, he was a vice president and head of portfolio solutions at Dimensional Fund Advisors. IFA, of course, offers portfolio implementations with Avantis funds. Hi, Phil. Thanks for taking the time to discuss how investors can help you become more educated about dealing with heightened portfolio volatility.
It's my pleasure, Murray. Thanks for having me.
You folks have researched stock market fluctuations through peaks and troughs over multiple decades. What really stands out from such data is that the range of negative outcomes in bull markets, as well as more bearish times, on average, weren't probably as much as investor might have imagined, correct?
Yeah, so I think if you think about, expansions and recession, that's a scary word for investors, the R word, right? Recessions. When we think about what that's describing, it's the economy, right? So is the economy expanding? That's an expansionary environment, or is the economy receding, the recessionary environment? And if we look back through time, what we've seen is, if you think about stock returns over the long term, they tend to do pretty well, right? Let's say about 12% a year, right? But if we compare that recessionary environment versus that expansionary environment, we do see pretty significant differences in returns, right? You see them above that average return in the expansion. You see them well below that average, even slightly negative in that recessionary environment. So that's part of the reason why you see people get concerned around that recession word as it gets into the media, and a lot of people start speaking about it. They get worried about their portfolios, which is perfectly natural.
And the average length of months in terms of recession is something like 10, 11, something like that, a little around a year, basically, right?
Correct. Yeah, a little less than a year. So if you look back in history, if we observe the recessions that have been recorded, and these are, it's important to note, these get identified after the fact, right? So NBER, National Bureau of Economic Research, are the ones who actually come back and say, it turns out we were in a recession. Here's when it started, and here's when it's going to end, or when it ends, excuse me. So they don't know that in advance, right? We don't know that in advance. We're looking at a whole bunch of data and making that determination. Typically, they'll be looking several months back to say, here's where we actually started the recession. So if we compare, though, the length of time for those recessions that have been documented versus the expansions are much, much longer, on the order of, say, 6 years compared to less than a year for that average recession.
And what's interesting about your data is that the average monthly loss during the height of a recession, the deepest point, it's not really, it's way less than 1%, correct?
So yeah, the average loss is what. So while the average stock return in that documented recessionary period is negative, it's only really slightly negative. As you said, it's a lot less than negative 1%, or smaller than negative 1%. So that's not so bad, right? But it still obviously can be a little bit of pain for an investor.
Sure. And by contrast, during expansionary periods, the average monthly gain is well above 1%, correct?
Yeah, a little north of 1%. So if you think about, we've got the average of 1 over the entire period. You've got sort of slightly negative in the recessionary environment, and then slightly above average in that expansionary environment. So those come together there.
Okay. And then you also have looked at data in terms of the average market return during different points, first half, second half of a recession, in the first half and second half of expansion. And what have you gleaned from that information?
That's a good question. So when we think about it, because if we go back and look and we say, okay, here's where NBER said the recession began and when it concluded, if we get a little bit more precise and start to zero in, if we start thinking about these periods and breaking them in half. So let's go from sort of that peak If we think about the recession as being that peak to that trough, really, let's go from the peak halfway, and then from that halfway point to the trough. And then on the expansionary side, we're going from the trough halfway to the next peak, and then from that halfway point up to the peak, right? So instead of 2 periods, we're now talking about 4. And if we start to look at returns across those periods, it's that initial period. So from the previously identified or the identified previous peak to half trough, that's where you see very strongly negative returns. Really less than, or I should say, greater than -2%, right? So more than 2% loss on average in that period. Whereas the rest of the period, it's actually it's positive, and it's tremendously positive, or much higher than average, the overall average monthly return in that half, now we're in the half trough to trough period.
Yeah, and what's really interesting is you've also looked at how recessions have impacted small value focused investors, correct?
Yes, so that's another thing. So we're fortunate to have a lot of data to be able to look at. Ken French has a great website that has just a bunch of data that we can use to look at different groups of stocks and how they've performed over these periods. So again, if we think about, and all of this analysis that we're talking about, we're looking sort of from that 1973 to the end of 2021 period. So a rich history of data for sure. And so if you're thinking about that period and we compare how small cap value stocks represented by that Ken French Fama French Value Index there, small value index, if we compare that relative to the market, what do we see? We see across all those 4 periods that we were speaking about that they outperform on average, right? So they're outperforming the market, which is what we kind of would expect. And then if we start breaking it down into those 4 periods again, they perform a little bit closer to the market in that sort of peak to half trough. And then the last part where we're saying half peak to peak, right? They're kind of similar to the market, but in between there, if we think about that period of half trough to trough and then trough to half peak, they actually do phenomenally better if you look back, right? So much, much better than the market in both of those cases.
So I guess the takeaway from all of this is you're really risking shooting yourself in the foot if you try to time this and you're out of the market at any point, correct?
I think that's a good insight, Murray, and that's one of the, I always think about kind of going back to first principles as investors, right? And why do we invest in stocks to begin with? Well, we're deferring, right? We're deferring some consumption today. We're saving, investing that capital, hoping to earn a return so that we can have more in the future, right? And equities have been a great growth engine for investors over the long haul there. But it takes some patience, right? It takes patience, it takes discipline to earn those returns, because if you look back historically and you think about sort of pullbacks, right? If you think the stocks aren't going to go up every day, they're not going to go up every month, they're not going to go up every year. But when we look back over the long-term period, they have rewarded investors that have stayed the course there. If you think about something like a 5% pullback in the market, that's happened almost once a year. If you go back from previous peak, it's happened almost once a year if we go back through the sample. And so that's one of those things where you just got to be ready for it. You got to be prepared that it's going to happen, but that's not necessarily going to get in the way of you reaching your long-term goals if you can kind of stay the course over the long term.
Sure. And just to define what we're talking about here, a return of -5% from a previous high is technically a pullback. -10% is correction territory, and -20% is considered a bear market, right?
Correct. That's absolutely right. So there's all these definitions and vernacular out there in the marketplace. So you kind of have those cutoffs of 5%, 10%, 20%. Bear market is the most severe, right? Less than 20%, as you said. But I would say they all probably have a little bit of pain, and the bear markets are less frequent if we go back through that sample, just as the -10% periods are less frequent than the -5% sort of pullbacks. But in all cases, right, if you're an investor, it's that idea of, I had an allocation to begin with, and that if I was working with an advisor to set that, and that was part of the plan to help me reach my long-term goals, there's a good chance that that allocation that you had last week, last month is still very appropriate for you. So the best path forward is likely to, to stick to it, to rebalance, and then to hopefully to increase the chance of reaching your goals over the long term there.
Okay, thank you very much, Phil.
Murray, it was great to see you. Hope to be back.